Hi everyone, Emma Davidson here from the Global Value Fund. GVF has just released its half-year accounts for 2026, and this is a 5-minute video that hopefully hits the key points. As GVF enters its 12th year, I'm pleased to say that it's been a solid start for FY 2026. To put some numbers to that statement, for the 6-month period from the 1st of July through to the 31st of December 2025, global share markets in Australian dollars rose 9.6%. Global bond markets rose 1.2%. Australian share markets were up 3.5%. GVF's investment portfolio was up 4.4%. And GVF's total shareholder returns for the period were 8.3%. Turning to the financials, GVF maintained a dividend of 3.3 cents per share, fully franked for the half, so 6.6 cents per annum. That grosses up to 9.4 cents for the year, and almost 7% yield based on the current share price. Remember, folks, that 7% comes from a lower risk, highly diversified portfolio. Back on the financials and page 6 of the interim financial report, the GVF portfolio profit reserve now sits at almost $70 million. This covers the current 3.3 cent dividend well into 2030. I can also confirm that GVF has a franking credit reserve that allows GVF to fully frank that 3.3 cents for the next 12 to 18 months. Another highlight for me in the financials is the portfolio manager's letter to investors in the Appendix 4D. As usual, the letter is informative, it's articulate, and it provides an insight into how Miles, Mark, James, and Marius are thinking about the GVF strategy. This time, the team draw our attention to the reality that fundamentally based forecasters are projecting long-term US share market returns to be in the range of just 5% per annum going forward. And here on the screen is one of the graphs from the letter which illustrates this point visually for us. On the y-axis, you can see the price to earnings ratio, the PE ratio of the US share markets. The team is using the market's current estimate for company earnings over the year ahead. On the x-axis is plotted the 10-year annualized investment return you would have received had you invested in the share market at that valuation level. You can see the PE ratio of 25.6 today indicates annualized returns to be in the range of negative 5% to 5% over the next 10 years. It's a definite expectations adjustment. Unless you believe the US market can just indefinitely continue to defy gravity, or you genuinely believe that this time it's different. Miles, as usual, leaves us with a great quote from Benjamin Graham, but I'll leave you to read that quote and hear the team's reference to its relevance in the letter. Also in the financials is the fact that once again, the largely uncorrelated discount capture element of the GVF strategy has contributed to the majority of the returns so far this year. Those returns have meant that GVF has now returned $1 of value back to shareholders on the $1 that was originally invested. In addition, that dollar is now worth $1.40 as at the end of December. Looking at those numbers another way, consider my 3 scenarios. Scenario 1, a grandchild was invested into GVF at the IPO. Her grandparents elected to reinvest all distributions back into the company. That young girl today would have more than tripled her money. Scenario 2, a middle-aged investor such as myself decides to reinvest half the returns but keep the rest to pay my many bills. My money has doubled over that period and I have received income to pay off those bills. Scenario 3, a retiree has invested at IPO and decided to take all the dividends in income, the default setting for investors coming into GVF. Their $10,000 is worth $14,000 today, but importantly, they have had almost $10,000 in returns. I think these figures are impressive on their own, but when looked at in the context of the risk that was taken to achieve these results, that lower risk, the numbers become outstanding. Nothing would be possible without our amazing shareholders. It is thanks to all of you that we are able to report on 11 and a half years of results. So thank you, and thank you for listening.